Good afternoon and welcome to another episode of An Allocator's View by Markets Group. I'm your host, Sovaida Noronha, and I'm excited to be joined here with Saumen Chattapadhyay. Saumen is the Chief Investment Officer of OneDigital's Retirement and Wealth Division, as well as its registered investment advisor, OneDigital Investment Advisors. He is responsible for the overall investment platform, including the selection of investment offerings, due diligence of funds and managers, and overseeing investment strategies and models managed by the investment team. Saumen has over 26 years of experience in the asset management industry, holding C-suite leadership positions with institutions, investment firms, and wealth management platforms. He came from Carson Group, where he was the chief investment officer, leading their 18 billion investment platforms. Saumen is a veteran of asset allocation, portfolio, and risk management. Among his many accomplishments, Saumen introduced robust investment offerings and alternative investments to Carson Partners and Convex Capital. He developed a unique wealth management solution. Saumen, thank you so much for joining me in this interview today as we cover key trends and opportunities expected to drive change in the year ahead. We've got a lot to cover, so let's dive right in. Given the market uncertainty, what's keeping you up at night as we wrap up 2023 and look at 2024?
So Veda, first of all, thank you for having me in this webinar and talk with Markets Group. I believe 2023 has been an interesting year with the inflection points of mainly monetary policy by Federal Reserve and the battle against inflation. Now, during this time period, we have seen that there are some really, I want to say, volatile market period that emanated from geopolitical risk, bank failure, and whatnot. So I think if you think about toward the December, what really keeps me awake at night, although I would not love to be awake at night thinking about markets, but sometimes it happens, it's probably the battle against inflation, what Fed has been really engaged from the beginning of the year or even the last year with the all interest rate hike, whether it will be able to solve that hyperinflation problem. And I want to say that for the most part, it has been solved, but you never know. The uncertainty around high interest rate, implications on the greater economy, most likely in the financial system, and then inflation coming back. That's one thing. The second part, I want to say the geopolitical risk, for the most part has a fat tail. Sometimes those geopolitical risks can cascade into the fabrics of the financial system and can make market volatile, because at the end of the day, market is driven by the behaviors of its investors. It's driven by fundamentals, as we all know as an investment professionals. At the same time, sentiment matters. And that sentiment sometimes could be driven by geopolitical risk. Now, the way I think about the geopolitical risk, and as we all know that we have gone through war situations, which is really a curse to humanity, I want to say, besides any political color, the problem happens with the market. It's the market's perception about the economic and macroeconomic implication, which is the same macroeconomic and implications on the overall fabrics of the financial system. We do not see that evident right now, but there is always a possibility. And third, I want to say that overall, there are some possibilities that the economy is going to have a recessionary impact. Now, there are arguments for and against about it. There are probabilistic models, which talks about what is the chance of economy getting into a recession. Now, it is half and half. I want to say that there's 50% probability that we will see a hardcore recession announced by the National Bureau of Economic Research in the United States.
Okay. Flipping a little bit here, and you brought up economic outlook as well. So U.S. and global economic outlook. What are some of the risks and opportunities, and what should advisors really do to diversify their portfolios in 2024?
Yeah, so I think this is an interesting question because things are different for, I want to say, the developed markets, especially in the United States. And also then there are implications of the emerging markets and the overall Europe. So let's start with the US economy. I want to say that my outlook, that for the most part, the economy was grappled into this problem of hyperinflation. And there were questions about whether this is going to impact the labor market and the high interest rate is going to impact the growth or not. Anytime you have rates higher than the normal target, Fed's target, long-term target is 2%. Inflation, the Fed's middle or call it midpoint of Fed funds rate is about 5.33. So there's quite a bit of difference. And obviously, the borrowing cost is high for the companies. The labor cost is high, and so at the end of the day, the cost of goods sold is high, cost of borrowing is high. So that's going to impact the bottom line. That was kind of the concern. But for the most part, I want to say that we have navigated pretty well during this environment, despite that high interest rate has impacted. Disposable income of investors is pretty strong. And I want to say that in 2024, the disposable income is going to drive most of the, US is a consumer-driven market. And that market is driven mostly by the consumer discretionary, is obviously tech and healthcare that are pretty strong. We have seen that with the advent of AI and other things, tech is getting stronger every day. But on the other hand, if I were to think about what could go wrong, the inflation is subdued right now. I want to say that it's closer to the target. It is about, forward-looking inflation about 2.3, although there are different measures, 3 and change for CPI. But Fed cares about personal consumption expenditure, or PCE, and then the forward-looking inflation, which is 5-year forward, or even 5-year forward, is about 2 and change. That's not too far from Fed's target, and that is a good news for the most part of economy getting back on the course of growth. And one of the things that happened is in the market, the equity and fixed income got correlated. If you look at last year, and even some earlier part of this year, the portfolio allocation, portfolio positioning was difficult because equity and fixed income tend to go in one direction when they are not supposed to, at least on a downward basis. People do not mind equity outperform, bond outperform, but they do mind when equities and bonds go down together. So I want to say that there is a case for including alternative investments. At the same time, I believe the outlook for fixed income has gotten better with the higher interest rate and also inflation coming down. I believe that we are going to see a bull steepening, and a bull steepening means that lower end of the curve is probably going to go down. And right now, the market is anticipating that from 5.33, the rates are going to go down somewhere around 4. But next year there is a possibility of at least 1 or 2 rate cuts, and if economy goes into recession, then we will see probably more. And that probably is going to signal a little bit favorable for the equity market, but at the same time there are concerns that Fed is not going to pivot the rates too low because it could signal that we are going into a recession territory. Now, for the European market, though, it is a little bit different because that is driven by the ECB's policy, the growth in Eurozone or Euro area, and then the emerging market has had challenges because of the higher rates from the US. Their banks were trying to keep up. There are some concerns about the growth and productivity, and also, all in all, the currency matters between the dollar versus where the emerging markets currencies are. So those are kind of the moving parts of the economy. For the most part, I want to say that 2024, the outlook is positive. At least, US and developed markets, we believe that we're going to see probably around 2% growth in the US market, and then the rest of the developed markets will follow, unless there is a geopolitical risk, fat tail that could stall the economies. But overall, we're hopeful right now.
That's amazing. And have you changed your allocation strategy for the year ahead?
I want to say that there are a few things there. One is coming into the year, even for last year, we were underweight what is called the interest rate risk or duration in the portfolio. And we have seen that portfolio managers have increased the duration and taking advantage of the longer end of the yield curve. So we have taken that, a little bit up duration in the portfolio. We have, recommended healthy allocation to the alternative investments. 2023 has seen proliferation of alternative investments, private credit, private equity, and I believe that we also have recommended at least a healthy dose of and around 10% in the private markets, which is completely shielded by the public market from the public market volatility. So that is another change. I want to say that in the beginning of the year, there were some concerns about value growth, where the economy or where the market is going to go. Right now, we are slightly pivoted toward a growth outlook. At the same time, I want to say that we are not absolutely negative on value, so it's coming kind of closer with a slightly overweight. And I want to say that we are also more favorable on the large caps, with some allocations to the mid and small cap stocks. What makes it really difficult is how much you should allocate to the international markets. That's what kind of changed, because U.S. market has been so strong, and there's a home bias, given the U.S. dollar denominated portfolio. I want to say that we are maintaining some allocation to the international markets, but is very careful in the emerging markets, given some of the concerns and the political warfare with China, and unfortunately.
Unfortunately, yeah. Um, Speaking of recession, where is that recession, or do you think we're already in it? And what's your thoughts, and what does that mean for advisors, and what do they need to know to weatherproof their portfolios?
Yes, that's a good question. So let's talk about this a little bit. National Bureau of Economic Research, or NBER, has changed definition of the official recession. It used to be 2 quarters of negative GDP growth. Back when when people said there is an official definition. Now they changed it as the significant decline in economic activity. And every time the government agencies, they try to find things which are less definitive. I want to say that when they do not have to really give you 2 quarters of negative GDP, then there is recession, but it is not always associated with the significant decline in economic activity. Now, if you go back, we have seen that probably by the official definitions, we have had recession, but at the same time, we have seen during COVID that there was an official decision of recession, and then it came back up. Market pretty much quickly recovered from the downturn. So I want to say that for the most part, in 2024, people were, or later part of 2024 at least, that they were not using the R word as much. So they were saying the economy is going to be probably a soft landing or hard landing as opposed to recession. So before you go to recession, there are 2 more steps. Economy could be, 3 more steps. Economy could have no landing, soft landing, hard landing, and could be a recession. It's kind of all this, jargon words. No landing means that there is really not any growth. You do not want a stagflation situation, which is the worst of all. So the concern was that you're in a stagnation, and then you have inflation that combines the stagflation. Stagflation is the worst of all. You cannot get out of that vicious circle. Now that is over. Economy is growing, labor market is strong, and then you have the tailwind of monetary policy. Sometimes there's a hope that Fed is not raising the rates in every meeting. They are stalled. They might pivot. So that's going to kind of forestall this concern about the economy. Is it going to go into recession? Now, is it going to be a hard landing or soft landing? I want to say that we already are in a soft landing. This is kind of my opinion. And soft landing could go back and get into the growth mode if Fed policy goes in the right direction. Now, what Fed really does not want is to stop raising rates and the problem is not solved. Meaning that if inflation is still there, it raises its head, then Fed has to go and increase the rate again. Fed doesn't want to cut rates and go back and raise rates again. But Fed knows that the overall target rate is too high, so we might see some rate cuts. And I want to say that if the economy goes into that recession, or more than 50% probability, we will probably see more than 2 rate cuts, could possibly about 4. And if I may, I want to show, if I can find it in the Bloomberg chart. that kind of really, shows this pretty well. If you can see that this chart kind of shows that where the rates are going to go, they are about 5.4. You can see that steady decline. That is the implied rate, overall. Let me see if I can zoom it. So I believe that you probably is able to see that rate decline that is kind of in a probabilistic scenario that somewhere during 2024 at the end the rate is going to be around 4%. So that's about 133 basis points that the market is predicting. We may not see all the way to that, but there is possibility of at least 1 to 2 rate cuts, given that the economy is in the soft landing environment in 2024.
Okay. Let's change topics here and go to technology, AI and technology. What do you think is going to be the biggest impact for the wealth industry in 2024?
Yeah, people, the biggest implication would probably be embracing ChatGPT that everyone is talking about. That piece of software has gotten the highest adoption rate in a fraction of a second, and has been talked about everywhere. That's the fad right now. Now I can tell you that AI or machine learning existed for decades before. It's not a new thing. It has become a new thing, and you can go and read the history of AI. I believe the most concerning and also at the same time exciting implication is that it is going to make humans better. Now, what is the concerning implication? Then people anticipate, am I going to lose my job and the machines are going to take over? I don't believe that's a possibility, because at the end of the day, you need humans to make human decisions. Now, some of the decisions could be made more efficient. We have seen that. When the robo-advisors came, for example, all the advisors thought that they're going to be losing against the robo-advisors, but robo-advisors actually made the advisors better with the technology, and we probably will see that the implication of AI. Now, one of the things that I would like to kind of mention, that because of AI, the technology sector is becoming much more powerful. It is already powerful, but it's becoming much more powerful because the enterprise data management and the security, where I believe that the main application of AI is going to set in, those are going to be what I call technology staples. Now, people have heard about consumer staples. I want to say these are technology staples because of the help with AI. Now, with advisors and what we do in the wealth management industry, that there's going to be a tool where you can ask questions and there will be answers. So you do not have to go and Google it 15 times or go back to the database and say, how do I find a question if my client asks this? Those are going to be efficient way to handle client's question. Now, in terms of portfolio management, will AI really create the portfolio? Maybe or maybe not. And why maybe not? Because at the end of the day, I want to say that advisors are life coaches. You have to understand the emotions of your clients rather than just using investments or wealth management as a commodity. This is one of the things that wealth management and investment, those have become commoditized. You need human to decommoditize it, because you got to take into implication the emotions of your clients, and this is why human plays the role and AI helps, as opposed to AI actually plays the role and human has no role.
So I have to ask, are you for ChatGPT or against it? Or are you just neutral right now?
I want to say I'm neutral. At OneDigital, we have been working to embrace the AI technology. I'm hopeful, but I have not used in real terms. Obviously, there's like you can test some of the things, but I'm hopeful. With the ChatGPT as it stands, I believe there are different software providers have different versions. At the end of the day, you need your own version. So I think you need to customize that. And that's why I'm neutral, but I'm going to be trending toward positive when we have a version for us that's going to help our process and our advisors and with the final implications of a positive outcome for our clients.
Absolutely. What are you doing that is unconventional, and what is your philosophy behind your approach?
This reminds me when you think unconventional. David Swanson wrote a book back in, I want to say, 2005. The name of the book was Unconventional Success. And now David Swanson used to be called as the father of modern portfolio management, not modern portfolio theory, is the modern portfolio management. Now that book was written, who David Swanson is. He was the CIO of EL Foundation, who took EL to flight, and his theory used to be called the EL theory of portfolio management, was taught at Harvard University. And David Swanson wrote What is Unconventional. He said, if you fail in conventional wisdom, it is better. But if you succeed in unconventional wisdom, you'll be criticized. So my unconventional wisdom, what we are doing is to recommend alternative investments in clients' portfolio that includes private equity, private credit, hedge fund, and private real estate. And that real estate also includes some of the new options like 1031 exchanges, 721 UPREIT, qualified opportunity zone fund. These are Greek words to some investors. They don't really understand it. At the same time, people have what is the main fear in clients' mind is the fear of missing out or FOMO, and you do not want to miss out something that is opportunistic for you. At the same time, you do not want to take all in all if it is not good for you. So I think we are recommending on a case-by-case basis, and this is exactly what OneDigital Advisor adds value, because they understand the client's suitability, they understand client's objectives, and they recommend a portfolio working with me and my team of 17 at the OneDigital investment team. This is what we are doing unconventional. We are saying that don't fear alternative investments. Don't let yourself have that fear of liquidity that if you invest in alternative investments, either you're going to miss money or not going to take out. At the same time, we do not want you to have 100% in the alternative investments. Again, you have to be unconventional, but there's a healthy dose of mixing between conventional wisdom with the tangent of unconventionality.
All right, this was super insightful. Any thoughts, advice to other allocators? Final thoughts, advice.
Other allocators, I think selection matters. At the end of the day, I want to say that it is important that wherever you are investing, which investments you are taking in your portfolio, be it an ETF, mutual fund, individual stocks, you really need to understand what you are investing in. If you are holding a 60-40 portfolio with 2 ETF, that's a completely different thing. You do not really have to pay an advisor and investment management fee for taking that beta in the portfolio. But if you are selecting funds and individual stocks, you need to understand that what you are selecting. And at the end of the day, allocators have to be mindful of what fee they pay to a manager, because you do not want to get an investment product that is beta in the suit of alpha. So you do not want to pay for alpha and get beta in your portfolio, or pay for you are attempting to get excess returns and the fee matters. The manager may deliver you just the market portfolio, which doesn't make any sense. So it is important for the allocator and advisors to understand the difference between alpha, which is excess return over benchmark, and the beta, which is your systematic market portfolio. So that's my advice to the allocators and advisors, to understand it.
What about Gen Z, the next generation that's coming up?
Wow. Gen Zs are a different cohort and completely different from the rest of the population. They are smarter. They understand a lot more. Just understanding how my daughter thinks about the investments and these days. I want to say that Gen Zs are going to be driven by investments that brings experience and that also brings closer to their financial goals. Because if you are going to only pitch about the investment portfolio asset allocation, but does not bring in their goals in life, it is not going to gel in. And I want to say that Gen Zs do not want to be taught about theories because they already know it, and they want to know is that how this is going to help materialize their goals, and that's important. And also, I think it has to be driven by a technological experience. You cannot have 50 pages of report, sent to a Gen Z by snail mail, and it's not going to cut through. They're not going to go over, but you can send them a digital copy. I believe that's going to be taken as a positive. I also want to say that advisors have started to include younger advisors in their mix because there is a generational wealth transfer. I want to say there's projected about 80 trillion in next 10 to 20 years. And if that generational wealth transfer happens, then this Gen Z is going to be the richest cohort of the world because they will have the major wealth for the generational wealth transfer. So everything is going to change from that standpoint. And I think with the advent of AI, with the portfolio allocations going toward a more alternative investments, which require deeper understanding. And also, I want to say that planning is important. OneDigital is a planning forward firm. You do not want to only recommend portfolio without outlining what is this going to solve the problem for the Gen Z. Gen Zs are all about connecting between a problem and a solution. It's not the commodity or the product, it's the solution to a problem. So I believe that they will be looking for a great comprehensive financial plan with a great experience and a solution that solves problems in their life and also help them materialize their goals through this investment process and planning.
Purpose and meaning. That's what they're looking for as well. Purpose and meaning. Saumen, this was super insightful. And before I let you go, I must ask, given that we're heading into a new year, can you share one of your New Year's resolution for 2024? Personal, I must say.
I love outdoor and I love hiking. And I used to be in the national parks and hikings with my cameras. I'm a photographer. I think given my busy days at work, I do not get as much chance to get that. So my New Year resolution probably to pursue some of my other interest, along with the work to make it a little bit fun and probably release some of the tensions and worries, and so that I can sleep better at night.
Absolutely. That sounds wonderful. Well, thank you so much again for joining us today and sharing your expertise and perspectives with our audience. Saumen will be speaking at a few Markets Group events in 2024, including our Private Wealth DC Metro Forum on March 21st in Bethesda, Maryland. To register for this event or another Market Groups event, reach out to me directly at sovaida.noronha@marketsgroup.org. Wishing you all a wonderful holiday season and a prosperous new year. Thank you so much.
Thank you, Sovaida.